What if your retirement savings were secretly being funneled into crypto? It's not as crazy as it sounds. Pension funds, the bedrock of safe traditional investing, are starting to look at Bitcoin. But they're not going all in like a Reddit day trader. We're going to break down exactly how these huge financial players are dipping a toe into crypto and what that could mean for your retirement. Today we're talking about something that could totally change how you see your retirement savings. As the whole financial world gets a facelift, pension funds are hunting for new ways to grow your money, and Bitcoin is suddenly on their radar. So, are your retirement dollars getting a dose of crypto without you even knowing? Let's get into it. First, why are pension funds, which are famously cautious, even looking at Bitcoin? Well, for years they've been stuck between a rock and a hard place, with low returns from traditional investments. With inflation and shaky interest rates, the pressure's on to find anything that can deliver better growth. This isn't just a theory. We're seeing real action. In 2024 and 2025, lawmakers in over 20 U.S. states have introduced or considered bills related to letting state-controlled funds, and that includes pensions, invest in digital assets. This signals a huge shift towards diversifying retirement portfolios. But they're playing it safe. Most of these proposals cap crypto investments at 5% to 10% of the total fund, so it's more of a calculated experiment than a reckless gamble. Let's look at who's actually making moves. A big headline maker in 2024 was the State of Wisconsin Investment Board. They invested in spot Bitcoin ETFs, which was a huge deal for a public pension fund and a major nod of approval for crypto from the mainstream. But it's crucial to understand they're mostly doing this through regulated crypto ETFs, not by buying Bitcoin directly. This gives them exposure to the crypto market while dodging some of the headaches like volatility and secure storage. Then you have Indiana, where House Bill 1042 isn't just a suggestion. It would require many state retirement plans to offer at least one crypto ETF option. The bill also expands the power for several public pension systems to invest directly in those ETFs. It's a bold move that focuses squarely on regulated products while still banning direct holdings of crypto. So, how does this work? The magic word is ETF, or Exchange Traded Fund. But forget the idea of a basket of various cryptocurrencies. The main vehicle for institutions right now is the single asset spot Bitcoin ETF. These ETFs trade on regular stock exchanges, so they feel familiar and comfortable for pension managers. They offer a regulated way to get into Bitcoin, which helps with security and compliance worries. But don't forget, even though it's an ETF, its value is still tied to Bitcoin's price, which can swing wildly. What does all this mean for the future of crypto in your own retirement account? On the one hand, having pension funds on board could bring more legitimacy and stability to the crypto market as big money flows in. But there are serious risks. Bitcoin's famous volatility is a massive concern for managers whose primary job is to protect retirees' money. That's why many large funds, like North Carolina's, have chosen not to invest in crypto at this time. Their treasurer has noted that while new laws might open the door, the system is a low-risk investor and needs to see a lot less volatility before jumping in. The rule book for all of this is being written as we speak. In August 2025, a federal executive order was issued that started a major review. It directed federal agencies to study and figure out how to safely broaden access to alternative assets, which includes digital assets, in retirement plans like 401ks. It's not a free pass for crypto, but more of a let's figure out the rules of the road directive, with a heavy emphasis on risk management and fiduciary duty. This order doesn't force anyone to invest in crypto. Instead, it just opens the door for more diversified retirement portfolios and pushes fiduciaries to seriously think about a wider range of options. Despite the excitement, this move into Bitcoin isn't a walk in the park. Advocacy groups like Better Markets have been sounding the alarm, pointing to extreme volatility, murky regulations, and the risk of fraud. They're not just expressing concern, they are actively pushing states to enact statutory prohibitions to ban crypto from public pension funds entirely, arguing it's a betrayal of public trust. And they have a point. Many pension funds are still trying to figure out if it's responsible to invest in such a new and unpredictable asset. the slow and steady approach you're seeing is all about one thing: trying to find new growth without gambling away retirees' futures. So what's your take on all this? Are you cool with the idea of your retirement funds getting a taste of crypto, even in a small regulated way? Drop your thoughts in the comments below. And if you found this breakdown helpful, make sure to hit that subscribe button for more insights on finance and crypto. So yes, pension funds are quietly buying Bitcoin, but they are doing it with extreme caution and almost exclusively through regulated spot Bitcoin ETFs. It's a balancing act between chasing desperately needed returns and upholding their duty to keep retirement savings safe. As the rules change and more funds test the waters, it's more important than ever to know what's happening with your money. Thanks for tuning in as we unpack the quiet shift of pension funds into the crypto world. The financial game is always changing, and staying informed is your best move. See you next time.